All right, let's get right into it. Today, we're breaking down an analysis that paints a pretty bleak picture of the US economy. It argues that a major market unwinding isn't just coming, it's already here. So what's fueling this so-called panic? Let's dig in. So right out of the gate, the source we're looking at starts with a pretty dramatic claim. Markets are a sea of red. We're talking about the S&P, the NASDAQ, even giants like Apple and Cisco getting hammered. The argument here is that this isn't just some minor dip, you know? They're calling it a massive liquidation event.
And this really gets to the core of their argument. They're calling it the mother of all liquidity squeezes. So what does that actually mean? Well, in simple terms, there's just not enough cash in the system to keep everything afloat. It's like a game of musical chairs, right? The music stops and everyone scrambles for a seat, only to realize there aren't enough. In this case, the chairs are dollars. And when that happens, people are forced to sell everything. We're talking stocks, gold, you name it.
Okay, so the big question is, why now? What is going on? Well, according to this analysis, it's not just one thing. It's actually 3 separate financial storms that are all starting to merge into one giant one. So let's take a look at each of them. First up, storm number 1. This one hits close to home because it's all about the foundation of the entire US economy, the American consumer. The source argues that this main engine of growth is seriously starting to sputter, and the pressure on regular households is just becoming unbearable.
And just to give you a sense of scale here, think about this number, 70%. That's how much of the entire US GDP comes from consumer spending. That's huge. It means that if the consumer is in trouble, the whole system is in trouble. It's not like other countries that can rely on exports. For the US, it's all about us, the shoppers. And the central claim here is that this very foundation is now under threat.
And you can really see the problem right here. The source points to data showing that severe delinquencies, we're talking people who are way behind on their loan payments, are getting scarily close to the same levels we saw during the 2008 financial crisis. I mean, come on, that is a massive red flag. So what's causing all this? Well, the source says it's an attack from all sides. You've got home sales plunging. You have insanely high interest rates, making it almost impossible to afford a car or a home. And then on top of all that, tariffs and a weaker dollar are just driving up the price of everything you buy. It's a perfect storm of financial pressure.
Okay, so that's storm number 1. Now let's move to the second one. Here, we're shifting gears from Main Street to the corporate world, focusing specifically on the massive, high-stakes gamble that big tech is making on artificial intelligence.
Just look at that number, $600 billion. That's what this source projects the hyperscalers, you know, your Amazons, Googles, and Microsofts of the world are going to spend on AI infrastructure in a single year by 2026. The desperation to win the AI arms race is just fueling an absolutely unprecedented spending spree. Which leads to the million-dollar question, or I guess the $600 billion question. Where is all this money coming from? Is it just flowing from their massive profits? Well, according to this analysis, the answer is a bit more concerning than that. It's coming from debt, a ton of it. The source highlights that the tech sector now accounts for a staggering 12% of all corporate bond issuance. Now, to put that in perspective, that is 5 times higher than it was at the peak of the dot-com bubble. 5 times. And here is why that matters for everybody else. This massive borrowing spree is creating what the source calls a liquidity drain. It's essentially sucking capital away from other vital parts of the economy to fuel the AI race. Money that could go to manufacturing or small businesses is instead being funneled into data centers. All right, on to the third and final storm. This one's an international one, and it's a little bit complex, but stick with me because it is absolutely critical to this entire argument. It's called the yen carry trade, and the source argues it's basically a ticking time bomb for the US markets. So what the heck is the yen carry trade? Well, for years, big investors have used this strategy. They borrow money in Japanese yen, where interest rates have been near zero, and then they invest that super cheap money in places with much higher returns, like the US stock market. Let's walk through it real quick. Step 1, you borrow yen for almost nothing. Step 2, you swap those yen for US dollars. Step 3, you buy things like US tech stocks that offer a much better return. This simple trade has funneled hundreds of billions of dollars into US markets, propping up asset prices for a long, long time. Now, here's where it gets dangerous. The source argues that this whole trade only works if three things are true. US stocks are going up, the US dollar is strong, and interest rates are stable. But what happens when all three of those things reverse at the same time? Well, that's when you get what the source calls a triple threat. And that reversal, it's apparently already happening. The source points out that the dollar has dropped 4% against the yen just recently. So all of a sudden, even if your US stock investment stays flat, you're losing money just on the currency exchange. And that is the kind of thing that could trigger investors to unwind the trade, which means selling their US assets, and fast. So let's bring all of this together. We've got three separate storms: a squeezed consumer, a debt-fueled AI bubble, and this fragile international trade. But the source's ultimate conclusion is that these are no longer separate problems. A quote from the analysis really sums it up. The storms, they're all converging. The argument is that these crises are now feeding off of each other, creating a dangerous feedback loop that's speeding up the whole downturn. And you can see how it's all connected, right? The weakened consumer can't support the revenue growth tech companies need to pay off their AI debt. At the same time, high interest rates are hammering both consumers and corporations. And then, the potential unwinding of the yen carry trade threatens to pull the rug out from under the entire market. And according to this analysis, Wall Street is definitely noticing. The whole mood has shifted. The source claims that the big money investors aren't just cautiously selling anymore. They're now actively placing huge bets that the market is going to fall even further. Short interest, which is just a fancy way of saying betting against stocks, is reportedly the highest it's been since 2016. The selling pressure is being described as even worse than what we saw during the pandemic, and it's targeting the key pillars of the market, tech and financial services. And this all leads to a feeling of systemic risk. When a liquidity crisis hits, even assets that are supposed to be safe get sold off. The source notes that even gold saw a massive, sudden drop, which suggests traders are just selling whatever they can to cover their losses. The claim is that no corner of the market is safe. And so, we're left with this final, really provocative question from the source. Is that massive river of foreign money that has propped up US markets for years already starting to flow in the other direction? The source we've examined today argues the signs are clear. The question now isn't if the unwinding will happen, but how fast.